Oh, there we go. Hello, everyone.
Hey, Nate.
How's it going? Oh, you're a little echoey. I don't know if that's
Oh, no.
being on. Oh
I
no,
missed.
now you're fine. I think.
Hmm.
I think it's just you. I think it's just you bumping that microphone. It's very sensitive and it has a reverberation to it.
Well,
I think it's
still
what's
getting used
going
to it.
on.
It does have a cool light, a little light on it. Look at that.
The light's cool. Maybe you should turn off the lights. Go dark for the whole session.
Yeah.
We got Sydney from Pittsburgh, PA. I assume that's Sydney Crosby in the chat joining us. Thank you for being here, Sydney. Very excited to see you. Hi, Cyrus, Hank, Pat. Hello, hello. Hope everyone is doing well. We got a pack session for you today. I mean, as always, I guess we have a pretty packed session, but looking forward to it. I get to take over the reins today and do a pretty deep training on what I call automated exits, or basically how to kind of twist options to get the biggest advantage that there really is for regular traders in the stock market. So I'm excited about that. Jack is in Pinehurst. Well, I'm jealous, but I should be there, Jack. Hopefully next spring. It is on our list. We do a golf trip every winter, early in the year, and Pinehurst has yet to have happened. But we knocked a big one off the list with Pebble Beach this year. So Pinehurst, I think, is coming up next. Hi, Faith.
I'm not even sure what Pinehurst is, to be honest. I did go
Wow.
to the driving range this week, Nate. I've got like a little blister on my finger. Squeezing the clubs too hard.
Yeah, you might
Gotta
want
go
to
back to the
that
drawing
grip.
board.
Pinehurst is one of the more famous resorts in North Carolina. They have like 10 courses there now, or 3, all that kind of stuff. And then they also get the U.S. Open and other major tournaments on a kind of regular basis.
Awesome.
Most recent U.S. Open was at Pinehurst, where Bryson hit one of the best sand shots I've ever seen, made the putt. Rory faltered at the end. How do you not know this? This is very important information.
I'm catching up.
All right. Cool. Looks like I think everyone is seeing and hearing us. By the way, the market is just having a straight up flush right now. I mean, risk on, risk off, gold, everything is flushing at the same time. We've got just a straight up yank. Even my dear friend Progressive is down 1% when normally it helps me out and is green on days where we start getting this kind of flush. Financials are down, energy's down.
Nate, you should have seen my drawing on Progressive.
You told me after the fact, but I mean, I
did it here in the opening playbook. Hopefully you guys saw it. I like Progressive right now, but I think we're going to get this ascending triangle, little channel here until we get a break above 290. I think we're going to chop around with Progressive. Hopefully it holds up there and my lines hold true. But if they do, I think we'll get a break to the upside here very soon, probably in the month of June.
Well, I must not have been paying attention to your open playbook session because I didn't see your lines. But
hopefully you were at the Tuesday session when I said that I think the market's going to chop around this week. All right, I'll get next week wrong. So guys, don't listen to me next week.
And yes, we did pull a little bit of an envelope. So let me actually share. Oh, I guess I have to share my whole screen now, right? With this.
Yeah.
So that's going to be, you guys are going to have to bear with me as I figure out technology.
And don't forget, as people pointed out yesterday in the chat, there is somewhere when we share screen, there's a full screen button. So if the screen looks small, look for that full screen button.
Yeah.
Margaret, we will talk about Tesla today, which is probably getting flushed out the most.
Yeah, down 5%. Well, down 6%.
Do we have a strong market button? I love it.
Just watching. SPY down about 0.2%. So it's not crazy. It's just that everything was green. Bitcoin was up about 1%. Now it's down about 0.6. Like you said, Tesla getting flushed pretty hard. Mags as a whole down, but not crazy. Just got a couple outliers.
We've still got Amazon up, GEV up.
Well, GEV is always up.
Lulu, who has earnings today. I still have that trade open right now.
I do as well. I might close it
50.
before earnings though.
I know, I might too.
Just what? Let's see. What am I up on Lulu? Yeah, 50%. Yeah, might be worth
It's
taking that one.
Oh, wow, silver I did not see silver up 3.5% today.
Oh wow.
Is that all-time highs?
I don't think it's all time
Oh,
highs. Is it?
no. I saw it and said someone in the chat said historic highs, but no, it's still got a ways to go.
Yeah. Okay. Yeah, actually, XLK amazingly is one of the only sectors up. So technology is up while the mags are down and everything else is down, and Tesla's down over 5%. Very interesting. Oh, Cheryl, good timing. XLK. Okay, is everyone seeing my screen right now? And did you guys find that full screen button so you can get this viewed up, hopefully as big and nice and clear as possible? I also mentioned up in the top right corner, you should even have like a hide sidebar button. I know maybe not all attendees have it, but either way, hopefully we are good to go. You guys can see and hear and all that good stuff. Let's jump in. We pulled an audible today. I guess that's the first bit of news for you today. I was going to originally today, I had on the slate to do a pretty deep dive on some energy research that we've been putting together, really talk about why I think a different energy revolution is starting to kick off. There's a lot of data and stuff that we pulled together. I'm excited about that. It is a bit of a pattern interrupt because it's very, kind of macro, fundamental, looking at real long-term opportunity. And I am still going to share that, but I'm going to share it tomorrow. Okay, so make sure you're on tomorrow. Please don't miss that. We definitely want to cover that, and I think it's a really important topic and, frankly, a very timely topic. So that's going to be tomorrow. Today, our new agenda is I'm going to go through the spreads and automated exits training, something I get a ton of questions on, maybe more questions than almost anything else. And then we're also going to see if Jack can hop on kind of last minute because we had this big Tesla flush. And so now we feel like there could be another setup. And Jack is trading this in a way that actually very much lines up with what the training I'm going to give you today is. So happen to just be a perfect balance there. So we're still working on getting Jack to jump in, but I think he's going to be able to jump in here before the end of the session and go over that with all of you as well. Guys, I'll try to keep an eye on the chat as much as I can. I am sharing my full screen, so it makes it a little bit harder, but I'll do my best, and I'll rely on Graham to call anything out that's super important. But let's get into the trading. So you guys will often hear me talk about twisting options or hijacking options. Let me, before I jump in, let me do one quick test here. I'm guessing because I'm sharing the tab. Graham, can you see if I draw on the chart like this, or does it not show up because I'm sharing the tab?
I'm not seeing any drawings now.
Yeah, probably not going to show up. Okay, let me do this another way because I am incapable of teaching without drawing. It's a problem. All right. Now I just got to maybe get my Telegram out of the way there, so hopefully those won't. Okay, now can you see if I draw on the screen?
Yep, looks good.
Right.
And what did you hit to share there? Because it looks the same on the screen.
I'm just sharing the entire like the entire screen monitor versus just the Chrome tab.
Okay.
All right. Sorry, guys. Moving on. So the reason that I like twisting options is because I think regular options are almost impossible to trade consistently in today's world. And today I want to show you and give you a deeper dive on, kind of how these twisted options actually work, and specifically get into why I like using the automated exits. All right. Now, the goal of this approach is to take advantage of smaller market moves without even knowing when to exit and without having to predict what the market is going to do or where a stock is ultimately going to finish. Okay. Keep that in mind. That's a really big part of this, is not having to predict where a stock is going to finish. Now, you might recognize this approach from my flagship strategy, automated options, where we're always giving it a 14-day window. So it's an example of twisting options and giving it a 14-day window. Sometimes that move comes early and we're holding the trade for just a couple of days, or sometimes the move comes later and we're holding the trade for 13 out of the 14 days before we get that move. So it can happen at any point in the trade. But regardless, all we need is a big enough move in our favor at any point, guys. This is the important thing. At any point during the trade window, and our broker will automatically catch us out with a win. In my opinion, This is the single biggest advantage in all of trading. The biggest advantage to me in all of trading is taking away some of the timing and predictive nature of the market and letting it give you a win without nailing those things perfectly. By the way, before we jump into the next session, I always throw the slide in there so I don't forget. Members, you can email me directly. Also, make sure you're in my Telegram and also make sure you're on the SMS list so that you get the text of the day. Just throwing that in there so that no one forgets on a regular basis to do those things. All right. So, how does the kind of spread, the twisting options, the automated exit, how does it all work? Tom Busby blowing me up on Telegram. Okay. First, we're using a debit spread. Now, today I don't have time to rehash like all the regular debit spread trading. What is a debit spread? How do you do it? All of that kind of stuff. But the cool thing about this lesson is you'll really get an idea of the concept, even if you've not traded debit spreads. So even if you're not like really experienced and you know debit spreads, you'll still get a good kind of grasp of the concept and why it's so valuable from today's training. All right. And there are three elements that I like to think about when putting a spread together. And this is, for me, I hope the part where I can kind of simplify it for you and give you a little bit of a light bulb moment of how to think about these trades. If you guys remember earlier or last week, we talked about like really setting up risk rewards and how to understand risk reward. This is kind of a deeper level of that and giving you greater context for setting up those trades. And the things that you want to know when you're setting up a spread are how far, how long, and how much. Okay, repeat after me. How far, how long, how much. That's really what you want to know to properly plan your trade. So how far is the first one? How far do I need price to go in order to give me a win on the trade? I'll often call this the line in the sand. That line of price of where you need a stock to go in order to give you a win on the trade. That can be anything from requiring price to go up a lot or up a little or even down. So as long as it doesn't go down more than a certain amount. This is for a bullish trade. So for a bullish trade, you can set it up where I need price to go up $10. I need price to go up $5. I need price to go up $1. Or I just need price to do, not come down more than $2, right? Think about it like this. So this is kind of your how far equation, right? If I'm trading this, I can have it where, hey, as long as it does better than 0%, anywhere here or up here or down back to here, anything above 0%, by the time it expires, I get a win, right? So that's one way. Or I could do something like up here, where anything underneath that, if price goes up, it finishes lower, stays down, anything below this is going to be a loser, but anything above this is going to be a winner, right? But you could also set up the trade where anything better than a negative 4% is a win. So this entire box is your profitability zone as long as it finishes above that level. All right. So think about this when you think about how far. What am I asking the stock to do in terms of price? Let me just pause for a second and ask you guys, does this make sense? The first thing you're doing is you're picking your line in the sand where a stock needs to finish, and it can be any value essentially within the market, but you have to know relative to the current price where it goes. Just give me a yes in the chat if you guys are following along and you know that, you're understanding that this is kind of the first step, picking where you need price to go relative to the current price on any trade. All right, good. Okay. So a spread based on each of these is going to have a different cost. All right, very important. A spread based on each of these is going to have a different cost. A line in the sand that is way above price is going to be cheaper because it's less probable. Okay, so the higher the move you go up, it's going to be less expensive because it's less likely that the market's going to get there relative to current price. A line in the sand well below price is going to be more expensive because it's very probable, right? If you trade this and you say, as long as the stock doesn't go below negative 4%, I want to win. Well, the market understands that that's very likely. that of all those scenarios, it's more likely that it's going to finish, somewhere above -4% over any time frame. So it's going to be more expensive because the market is based on probabilities. But how far, or in other words, our line in the sand, is only part of the equation. We also need to answer the second question, which is how long? Okay, not just how far, but how long? How much time are we going to give the trade to get or stay above that line in the sand? Okay, if you start below, it just needs to stay above. If you start above, it needs to go above. But either way, you have that line in the sand, and you have to answer your question: how much time are we going to give it? All right, so let's go back to this. Remember, the first thing we're doing is kind of predicting or picking how far we want the price, to move. We could give it 3 days to make a move on any of these levels. In other words, we could give it 3 days to stay above -4%. We give it 3 days to stay above 0%. We give it 3 days to make a 6% move, right? No matter what line in the sand we're using, we're going to pick a time duration, and we could give it 3 days, or we could give it 2 weeks, which would be like over to here, like 10 candles on a daily chart, which is what this is. Or we could give it a month. No matter what value we're picking, we still have to pick our time. And this is where things get a little tricky, okay? Fair warning. This is where things get a little tricky. Remember, choosing the line in the sand is our first step, right? The higher we go, the cheaper the spread because it's less probable. If you want Apple to make a 30% move, that spread's going to be really cheap because the market knows that's not very probable. The lower we go, the more expensive the spread gets because it's more probable. If you say this the opposite, hey, as long as Apple doesn't go down 30%, I want to make money. Well, the market knows that's a very, very, very probable, and it's going to price it accordingly, right? Makes sense, hopefully. But what about time? And this is where I want you guys to pull up that chat. And I want everyone to answer in the chat. What about time? Does it get more expensive to give it more time as you go out and stretch it? More expensive? Or does it get more expensive as you give it less time? Which one is more expensive? Less time or more time? Let me know in the chat what you guys think. Are you paying more? More as we stretch it out? Or is less time more expensive? I'm patiently waiting because we only got about 20 chats, and I know there's 300 of you. So we should see a lot more than that. All right, now we're getting it. More. Joel says less. We got a couple less. We got a couple more. And a few people I already saw actually got this question right. It gets a little tricky here because the answer is it depends. And I actually saw a couple people write that. It depends. As we go higher, time is more expensive. Okay? So if you're going for a higher price where you want the stock to make a move, time is more expensive. You're paying for the time for it to make that move. Because it's more probable that a stock can go up 5% in a month than in 1 day, right? And again, at the end of the day, this is all going to be about probabilities and how the market is pricing it. So at the probability metrics, if I give Apple a day to make a 5% move, it's going to be pretty cheap. But if I give it a year to make a 5% move, it's going to be pretty expensive because the market knows it's a lot more likely that the market is going to make that move over a long time frame than a short time frame. Take our April 25th ANET example that we did right here in opening playbook. Maybe some of you guys are in this trade. This was a trade we set up in the Dream portfolio. What we're asking on this trade is for the price to go up about 20%. That's a big move. We wanted the price to go up about 20%. And we gave it 2 months from April 25th to June 20th, almost 2 months, to make that move. Notice it's a $5 spread, right? So $5 is the maximum value here. And we paid 90 cents for that spread. So the ROI potential is really, really good, right? The ROI potential is great because we only paid 90 cents for a $5 spread. And it makes sense that this is pretty cheap because we're asking it to make a big move. Again, in this case, going for that big move, the more time we gave ANET, the more expensive the spread would be, and vice versa. Okay? So if we gave it 2 days to make a 20% move, that spread would cost like a penny or 2 pennies, right? Because the idea that ANET was going to go up 20% in 2 days is incredibly unlikely. And the market knows that. So it's going to price that spread. It would have been like a 2-cent spread instead of a 90-cent spread. But if we gave it 2 years to make that move, it would cost like $2.20 because, of course, it's way more likely that ANET's going to make a 20% move in 2 years compared to 2 months. So 2 days would be incredibly cheap. 2 months, still quite cheap because it's a big move. 2 years, starting to get more expensive. So this is an example of requiring a stock to go up a lot where the market knows the more time you give it, the more probability it has to make that move. And it's going to charge you money, debit, for that probability. Higher we go, time is more expensive. Okay? Simple as that. Keep that in your mind. That's important. The higher your line in the sand, the more you're paying for time. But what about when we go lower? And here's the doozy for you. As we go lower, time is also more expensive. So time gets more expensive as you go up, and it gets more expensive as you go down below price. That's the tricky thing about time. Let me show you an example right now for today. Okay, let's just look at the market, and we can do this in real time. Okay, does everyone see my Thinkorswim? You should see SPY up here, and then you should see lots of expiration dates down here. Okay. Now, price right now is at 595 on the SPY. So let's say that by a month from now, what is it, the 5th? Okay, so the 3rd. So let's say a month from now, we want to place a trade where as long as price doesn't go down 1%, so 588, 589 would be down 1%, we win, right? 588, 589. So you go to the chart. Let's just look at this real quick. Oh, there's that painful progressive move. Let's go to the chart. Right here's the daily chart. We're basically saying over the next month, this box, remember, we got to choose time and direction. As long as it stays above this line right here, we win. Okay? As long as it doesn't go 1% down, we win. That trade will cost about 69.75. It's bouncing around, but about 70 cents. Now, the interesting thing here is the ANET example I showed you, as you went out more, this will get more and more expensive. But since we're going down in price, it's actually going to get more expensive the shorter you go instead of the longer you go. Let me show you. This is 588, 589 for June 3rd, 70 cents. But let's go to today and see that this gets way more expensive, not way cheaper. 5th of June. Now that spread is 95 cents. Okay, so does everyone see in the ANET example, as we went out in time for a higher price, time was costing us money. But now, as we want to go lower in price, time is getting more expensive as we get closer. It flips based on whether you're above price or below price. And this is something you really have to understand if you want to trade these different structures. Because it's easy to say, hey, time costs money in the market, but in reality, it depends on whether you're being defensive or aggressive. And it makes perfect sense, right? It's a lot more likely that SPY is going to move down 1% in the next 30 days than it's going to move 1% down in the next 6 hours. Again, the market knows that. It prices it accordingly. So this combination of where you want price to go and how much time you want to give it is really critical. If we went out like a year, it would probably only be like 60 cents or something. It's only basically going to price in the likelihood of, the market going up over time. Let's see. Oh, it's not going to let me trade the June 26th. I trade 31 March maybe. Oh, it's not trading the single dollars. I probably have to trade the $5. Let me see real quick. 588, 590, 340, little over 60% of the value. Not much, but basically just pricing in that the stock's going to go up, or that the SPY is going to go up over the year, because it does, 70% of the years go up. But if I go out further, it's probably not going to get a whole lot more expensive. Like if I go all the way out to January 27, it's a little bit cheaper. Whereas if you were going for out of the money, it would be getting more expensive because you're giving it more time to make that move. Let me show you. Let's say that we want the SPY to go to 620. So we set up a 615, 620. Okay, 290. That's what we'd pay for a very out of the money spread. Why? Well, because we're giving it, a year and a half to make that move. Now, let's say that we gave it to January 26th, so, 6 months instead of 18 months, and watch what the price does. 278 got cheaper. Why did it get cheaper? Because we're going above price. We're asking price to make the move. Okay? So this inverse relationship is really important. If you want to understand spreads, you have to understand that as you go up in price, as you ask the price to move, you pay for time to make that happen. But as you go defensive and you go under price, it's the opposite. Timing creates more scenarios for the price to go down. And now that time, as you go out, is actually the opposite. It gets cheaper. So hopefully that just understanding how far and how long, which is what sets up the price of a spread, gives you that good framework for how they work as kind of a practical level. Not about theta or beta or anything else, just how the market works with time relative to price, which I personally think is the most important thing to kind of wrap your head around. And then you can start structuring trades all kinds of different ways. So let's jump into my actual favorite technique here in terms of how to use these. Remember, everything we just talked about is based on where a stock finishes, right? Everything from a basic spread understanding of how much value it's going to be worth and all of that is all based on where a stock finishes on that expiration date. If it's above the line in the sand on a bullish trade, that is, at the expiration date, you win. If it's under that, you lose. Okay. And it's all based on where the price finishes at the expiration date. So take ANET, for example. Even though ANET was above 95 here, and I think it will end up above 95, we could still lose, right? It didn't matter that it hit our level because we haven't hit our expiration date yet, which is like over here. So it's not about where price was here or here or here. It's about where price is on this very specific date. That's what matters. And this is extremely common because if you haven't heard, stocks don't always go straight up and stay up. Might be news to some of you, but hopefully not. A lot of times stocks don't go up and then just stay there for you and finish at the price that you want. So I use a limit order, what I call an automated exit, on most of my spread strategies. Most of my spread strategies, I use this limit order or take profit or automated exit, whatever you want to call it. I like to think of it this way. And this is really if you guys want to understand my methodology for most of my strategies, you can pretty much bottle it up in this one statement. And if you're taking notes, this is the note that I would take. It's a lot more probable that a stock is going to go up at some point in the duration of my trade than it is that it's going to finish up on a specific date. Okay? That's really the entire framework of most of my strategies in a nutshell. I'll just do it on a demo here. So take this chart, for example. Right? You have 14 days between these two lines. Do you guys think it's easier that I can pick one of these individual candles and then a price that it's going to finish above? Wow, beautiful drawing there, Nate. One of these candles and a particular price that's going to finish above on one of these expirations, Or do you think it's easier for me to say, hey, take the entire box, and at some point, I think price is going to go up? Whether it's this candle, this candle, this candle, doesn't matter. I think at some point within this window, price will make a move. Or do you think it's easier to pick one of those expiration dates and say, I think price is going to finish higher at this particular level? I don't know about you guys. I think it's a lot easier to say, hey, I think at some point in 14 days, I think that price is going to go up in that range, than I'm going to pick a particular candle here and say that it's going to, finish at this level on this date. And this is what most charts look like. Most charts don't look like, price just goes straight up the whole time and stays up there. And traders really struggle to make money with this kind of price action, but I don't think they have to. So they might enter here, perfect entry, but 5 days later, they're down 50% on their options because of time decay, and they get out of the trade. And they might even enter here, great entry right before the move, but then they hold on a little bit too long, and they lose again, right? And while this chop kills most traders, it's actually a hidden gold mine if you are using targets. Because all we need is a relatively small jump in price, just like this, to hit a really juicy win. We're not talking about taking all of your profit away. We're talking about a still very nice ROI on a per trade basis. And we set it up so that our broker automatically cashes us out on the trade. Why? Because if we get some move over this range, you still have to exit the trade. And I don't know about you guys, but I'm not watching every minute to get out. I mean, I watch the market a lot, but I'm not watching every moment to try to get out at the top. And frankly, even if I was watching, I probably would make bad decisions and think, oh, maybe it'll go a little bit further. And then I still wouldn't get out. So for me, this is kind of the holy grail of not running into those very common issues. And this works on any kind of spread that you guys want to build. You can do this on literally any kind of spread. Whether it's an aggressive one, you're making a big move up, or whether it's a conservative spread where you're just looking for the market to do a whole lot of nothing. Either one. You can do it whether it's a very short-term position, like I'm holding it for 3 days, or whether it's a long-term position. Any spread, you can use a limit order and set up a target. All you need to determine is how much profit you're willing to give up for not predicting where the stock will finish. Okay? So you have to determine how much profit am I going to give up to trade my ability to predict the exact expiration of where the stock's going to end up versus I'm going to take it anytime I get a move, because there is a trade-off there, right? So you have to plan that. A good general rule for me is around 75% of the value on an aggressive spread and around 85% of the value on a more conservative spread. All right? So it's going to depend, obviously, what your entry price is. I'm using the value of the spread. Here's an example. Yesterday's overnight option trade, right? So this is a more conservative spread. This was our overnight option trade. We took the 595 and the 596, which is below price, and we paid about 68 cents to get into that trade. Notice down here what our target is. Okay, everyone see this? We set a good till cancel target immediately for 83 cents. The max value here is $1. So I am obviously giving up some of my potential here by putting in an 83-cent credit so that over the next 24 hours, I get out on one of these high moves versus having to predict that at 4 p.m. today, it's at the right level. That's the trade-off I'm making in real time when I set up a target. Now, I gave up about half of my profit potential on this trade. Okay, so I gave up, it could have been, a 40% winner, but I'm only going to get a 20% winner. So it's a smaller percent basis, 20 to 40, 20%. But of the total value of the trade, it is about half the total potential. Hopefully that makes sense, guys. Some of this math might take a little bit to click in. You might have to go through the presentation a couple times. For those of you who are in the options, VIP, the slideshows and everything are in there. So you pay the $1, which, again, we wanted to make it free, but we had to charge something to put it in the members area. So you pay the $1, you get all the calculators, you get everything in there. You also get the slideshows so that you can review stuff like this at your own time, because we do end up having to go through some of these sections fairly quickly. But for those of you who just want a general cursory understand on a percent basis, the more conservative you get, you're going to give a bigger chunk, but a smaller percent. Okay. Compare that to jump trade. So on a jump trade, we are going for, in this case, a 24-cent entry and a 74-cent automatic target, which is about 190% ROI. Okay. So this is a very different setup. The other one, we were going for like a 20% ROI. Here, we're going for 190% ROI. In this case, I'm giving up a third of my profit potential. So I'm giving up less compared to my risk, a third, but it's a larger percent basis. What do I mean by that? Well, if I went for the full dollar value, it would be like a 300% win. Okay, so it could have been a 300% win. Here, I'm only taking 190%. So on a percent basis, it's a quote unquote extra 110%, let's say. But as a ratio of the trade itself, it's about a third. So again, the more conservative you get, it'll be a larger chunk of your profit, but a lower percent basis. As you get more aggressive, it'll be a smaller chunk of your risk to reward, but a larger percent basis. That's just based on how the math works. And as a very general rule, you can use about 75% of the potential in a more aggressive trade. You could use, 85% of the potential on a more conservative trade. And that'll give you a pretty good rule of thumb to start using these targets. But the key in either scenario is that I'm not predicting the market to finish at the right price on the right date. I am making a very purposeful trade-off that I'm going to get a little less profit by making it, by getting out anytime we make a decent move over the course of, however long I'm holding that trade, 2 weeks, 4 weeks, 8 weeks, 1 day, doesn't matter. Instead, I'm saying if I get any move during the trade that is big enough to hit my target, take the money and run. Okay. So that is the trade-off that I'm making. All you do to set this up is you get filled on the entry. You have to do that first. Determine your exit price. Okay, how much am I going to go for here? And then set it up as a good till canceled limit closing order. So the way this works in real practice is that as soon as you get filled on the trade, you go ahead and set up your closing order. All right. So you get, an entry for 50-cent debit. As soon as that's filled, you set up the closing order. You set it up for 75 cents or whatever you're going to set it up as. And then you will be able to close your computer, walk away, whatever you want to do. And the broker will cash you out if you ever hit that value on the trade. Okay, does that make sense? Hopefully everyone's kind of catching on that. Now, you might need to know, how do you know what the stock needs to do in order to hit your limit? This is a question that I get. Everyone says, okay, well, I set the limit. What actually has to happen here for the stock to hit my target? Well, it's the exact same logic we talked about before. It has to do with time left and your line in the sand, right? So it has to do with how much of a move you're going to get and how much time is left on the trade. So for example, if you have 1 day on the trade, a little move is going to hit most targets, right? Just like I showed you today, that spread costs 90 cents for price to be 1% below because there's not much time left. But if you have a whole bunch of time over here left on the trade, well, a 1% move is not going to hit your target in most cases because the market knows there's lots of time. At the same time, if it makes a big enough move, it changes the ratio because relative to time, now the move is so big and you can still hit your target. So it's that ratio, it's that access of time and position relative to the current price that's going to determine whether you're able to hit a target. Okay. So hopefully that makes sense, that same ratio. So my big hope for you guys is that that logic starts, having a light bulb moment where that how far, how long, how much, that combination of factors begins to make sense for you guys. Because once it does, you can structure trades in so many different ways to take advantage of the market. And let me give you a quick example. Let's see if I have a chart up I can share here. Maybe I can share just something here to give you a decent idea. Let's go to just any chart. Someone give me a ticker that we can look at here. We're on ANET right now, which, by the way, is back above our line in the sand, which is always nice. Someone give me a ticker real quick that we can take a look at. Okay. Donna was first with Goog. Whoop. All right. So let's take a look at Google. Google's at 171. Now, let's take a look at the ATR on Google. Okay. So let me put this on 1 month. Okay. So Google, over the course of an average month, at least over the last 14 months, moves pretty good, about 10%, a little over 10%, $21, right? So Google has the ability to move around $21. Let's go look at Google and what it would cost to trade it for a $21 move for next month. Okay, so let's go to July 3rd. Let's go to regular options. And let's go to the 190 call. Boom, you could trade this for 67.70 cents. Not bad. If Google actually made this its full move exactly in your right direction, exactly starting now, well, you'd be in good shape. You could actually make some money on Google. Now, let's look at what the calls are right now at the money. 150, pretty good. Okay, so if you wanted to do, let's say, a much more reasonable trade here, let's say you wanted to do about half the value. Let me go to the monthly chart here. There you can see it. All right, so Google would have to get about halfway up. It'd have to have a pretty big daily candle. By the way, this ATR is obviously going to be extended because of the April flush. So maybe a little bit of an inflation of what Google would typically move. As a matter of fact, we could just set this up for 36 months. It'd be a little more reasonable. But anyway, that would require you to get the exact right move here of a bullish candle to 190. But let's say that you wanted to kind of cut that move in half and trade more like a 180, which obviously would be a much more, still a very directional trade, but a much more reasonable move for Google there. That option would cost you about $2, right? Now, here's the interesting thing. For that $2, oh, sorry, I got to go back. Keep flipping to the wrong. I got to get used to using this thing. For that $2 move, or for that $2 option, you need a 8% move in your favor, and you won't be at your break-even point at the end of expiration, right? You'll still need it to go above 180 to get to your break-even point. So you need an 8% move in your favor before Google starts to break even. By the way, if it did make a $20 move, you'd be in great shape. But let's just say you're not as aggressive enough to trade an 8% move in your direction before you get break even. Well, now that you know that from a directional standpoint, $8 or $9 is not a far stretch, you could actually go in here and set a spread instead. And instead of requiring it to get to the full, 180, you could just require it to get to 175. That's a $4 move. That's a 3% move. We started out looking for a 10% move. Now we're only looking at a 3% move. And this spread cost about $250, so about exactly 100% ROI. How do I know that? Because it's a $5 spread. So if I pay $250, I have about $2.50 of value on the other side. So I can make about 100% return over the course of 1 month. But instead of needing that 10% move, I can now do it with a 3% move. So you could take this trade. Now, the cool thing is, what I can do instead of waiting a month to see if this candle ends up being green is I can set a limit order so that if any time this month or the first 3 days of July, we get a spike up somewhere in that range, even if the candle ends up finishing down, I can actually get out with profit instead of predicting that that Google is going to be at a price of my choosing on exactly July 3rd, which again, in my opinion, is really, really hard. That's very hard to predict. And notice, by the way, these are monthly candles. Notice, by the way, how many candles make a move like that might not finish all the way up. This one did finish all the way up. This one made a move, 3% move, finished low. This one actually did finish up 3%, made a move, finished a little bit lower, made a move, finished a little bit lower. This one was up 3% for a minute, finished lower. Here we got, the April flush. This one obviously finished up. This one made a 3% move, finished lower. This one made a 3% move. This one made a bigger move, finished lower. Even this one probably made a 2% move, finished lower. Sorry, this is not the April. This is the August flush from last year. Even last month, we got some moves, finished lower. So the question is, do you want to require the 1 in 10 candles that finishes all the way at the top of the range, or do you want to let any of these moves get you out with profit? And for me, the answer is very simple. I want to let any of those moves get me out with profit. And the best way I've ever seen to do that is to set up a spread and then use a limit order that I'm not watching or managing my exits or, waiting for an alert or anything like that. If the value gets there, the market takes me out, cashes me out, and I'm on the sidelines with a win. And no matter what happens, the rest of that trade duration does not matter to me. Okay, so hopefully, folks, that makes sense. So I have any questions before I turn over to Jack? Because he actually uses a very similar approach to what I described today on Tesla, which is absolutely dumped the last few days. So we might be in a chance to get actually a new kind of momentum cycle here on Tesla after it flushed out about, what did it end up being? About 8% over the last 2 days, 9% over the last 2 days. We've now got a kind of a new floor on Tesla. But if you guys have any questions, we do have a couple minutes here, and I will try to answer them before I turn it over to Jack. Hey, Jack, how's it going?
I got to tell you, that was the most impressive lesson I've seen probably this year.
I thought it was great.
I love what you guys are doing here. That's do you record all these for your members?
We do. They're all recorded. They're all on YouTube. And then what we did, we actually created, I mentioned earlier, we created this little VIP section for people.
Yeah.
And our team, Dittman and Company said we had to charge something to put it in a members area. So we charge $1 for our for our lifetime access VIP members to get in.
So cool.
In there, we have all the calculators that we use. We have some scanners. We have we have all the actual PowerPoints so they can go and click through them at their own time. So that's what we kind of do on the side.
I love that. So, what's great about that, a lot of things, but the one thing is you can just base a percentage move and then build a trade around that to make multiple times what that move would be. Yeah, this is great, man. Do you do this every day?
Every day, 10 a.m. Graham and I, and normally it's pretty meat and potatoes training like this.
You're giving them an unfair advantage doing that every day. Man, I love it. Very cool. You know what you're doing too. That's a lot of these guys get on here and just ramble. It doesn't make sense. That was all meat and potatoes right there.
Thanks. Well, I think you're right. You mentioned something that I think is an Achilles heel of almost every trader I talk to, which you said, basically, how do they figure out where they're going? What line in the sand are they picking? What are they using the ATR? Right. And I see people say things like, well, I'm going to go $1 above price. And they do it on a $200 stock and then $1,000 stock. Yeah. And it's like just total randomness on how they are actually picking what level they're going to target. And then much worse than that is that most traders I talk to have no idea what they actually need the stock to do to get a win. They think they're trading for that level. The implied volatility and everything else means they're actually trading for a totally different level, and they get, beat up with time decay, which I know you've made a career on doing the opposite.
Exactly. I live off of time decay. But what you're doing here is really smart. Not just taking a straight up call, but using that debit spread so they can get into these trades for, like less than $100. And the upside potential, 50% is amazing. In these debit spreads, you can get 100, 200, 300, but if you just hit that 50, I don't know, is that your target, 50%?
It depends on the strategy. So a lot of them at 50%, like my main strategy is 50%. But, Jack, the other thing that's really crazy is if you actually do this on long-term trades too.
Yeah.
Graham and I were looking at, when we got that big dump, if you wanted to buy high-quality calls on all these stocks that were down, you're paying $10,000, $15,000 because you're trading them to the end of the year. Check out what we did. We built this. We did this for free for everyone on Opening Playbook.
Hit that second tab. I updated it yesterday with the price.
Okay. Check this out, Jack. We did this for everyone free 2 months ago when the market was at the lows. We said, guys,
I remember that.
You probably want to be buying right now, but you probably don't want to pay hundreds of thousands of dollars for stocks or tens of thousands of dollars for calls. The average spread going out, these are going out like a year, $3, $2, $1.35. Some of these are up 270%, 115. ANET was up what? Where is that? That's about 272.
Do you remember that trade that Graham gave on Tesla for 2026, March of 2026? I put that on, because I know you guys know what you're doing, but that thing already hit so early. I came out of that automatically, and that's the other thing I love is you got that automatic exit. So, you could be fishing or taking a nap or riding the motorcycle and you're already set up. But everything you guys are doing seems to be working. I love that long-term Tesla trade. That worked. I see one question in here. What's better, debit spreads or credit spreads? Well, they're two entirely different animals, and they both have a purpose. But right here, man, this is great stuff. Great stuff.
And you blended some of this automatic exit stuff into the Tesla trade, right?
I did. Well, you guys opened my eyes to it. I was, as you know, I was not a fan of debit spreads, and even though everybody that I admired was a fan of debit spreads, like that guy, who'd we trade with? That Wall Street.
Oh,
wizard.
Tony Saliba.
Tony Saliba. That was his favorite trade, and I just, we'd pick the stocks, and then he'd pick the spread and the debit spread, and then I saw the way you and Graham do them, and now I'm a huge, huge fan. Like the one trade we did on Tesla, it would have cost $1,380 to buy one call. But when we did it Graham's way, we got in for $128 and still have a huge upside. So it makes it so affordable, and it's so easy, especially when you put that GT good till cancel exit on it and automate the whole thing. I mean, it's kind of like, it's fun, and not too many trades are fun, but these are really fun. And you're doing it on the right stocks. That the underlying stock is always the most important thing. And you guys have an uncanny ability to get it right on the right stock. And, I might retire and just follow you guys now, I think.
I've been following you. I mean, I think the first ever spreads I did were because of you way back when. So I got to give you a lot of credit. And you're right, Tony. For those who don't know, Tony's in the Market Wizards book. I mean, he's a literal genius.
He is.
And he built a strategy tester that basically said, how do I get the best bang for my buck on a particular move in a particular stock? And most of the time it was a debit spread. Most of the time he would say a debit spread gives you the best ROI scenarios for a move.
They spent a ton of money figuring that out. That guy Paul that he works with.
Yep. Oh, he's a genius too.
He is. That supercomputer they had back testing and real-time data and all that, and it proved the facts. The debit spread was the way to go.
Well, and I think he also had all that data because he owned a brokerage of seeing how many people lose on calls and puts firsthand. And he just thought, oh my goodness, this is like a bloodbath for people who are buying regular calls and puts. So, but speaking of that, okay, so Tesla, you're gonna talk about Tesla, which we got a really nice flush the last couple of days. I just bought some more this morning, actually. And Tesla is especially cool for this because everything I just showed you, pick a line in the sand, then make a move above it. Well, guess what moves really, really well and hit those targets early if it moves in the right direction? A stock like Tesla. And so Jack's built a whole framework around doing kind of a microcosm systematic strategy around the exact concept, except for with, all the details baked in. When you take the trade, what target you use, which spread you use, what exit you use, all that stuff baked in to that strategy. And like I said, I'm not sure, Jack, I know you're looking for an entry today. I'm not sure if Tesla moved back up enough or not, but I know we got a potential one. And so we figured, let's get you on today. We're going to do a totally different training. I know Josiah called you kind of last minute yesterday. Let's get you on in case Tesla fires today, because, you only might get one opportunity a week or so. So let's get you on today and make sure you get a chance to walk everyone through how that works before that opportunity potentially triggers.